Are you new to investing in Canada and not sure where to start? In this video, I'll walk you through the exact steps to begin investing, from choosing the right account to picking ETFs versus stocks to avoiding common mistakes beginners make. By the end, you'll have a clear game plan to start building wealth the smart way. In Canada, the very first step is picking the right account to invest in. You have four main options: the TFSA, the RRSP, FHSA, and the non-registered account. The TFSA, or tax-free savings account, is available to anyone over 18. The biggest benefit? All your gains are tax-free forever, whether it's dividends, capital gains, or interest. As of 2025, the total contribution room since the TFSA started is $95,000 if you were 18 in 2009 and never contributed. But if you over-contribute, the CRA charges a penalty of 1% per month, so keep track of your limits. Next is the RRSP, or the Registered Retirement Savings Plan. This is best for long-term retirement savings. Contributions are tax-deductible, meaning you can lower your taxable income today. The downside, withdrawals are taxed as income later. You get 18% of your income from the previous year as contribution room, up to a maximum of $32,490 in 2024. Over contributions above $2,000 are penalized. Next, we have the First Home Savings Account. This is new and amazing for first-time homebuyers. You can put in up to $8,000 per year, up to a lifetime maximum of $40,000. Contributions are tax-deductible, like an RRSP, and withdrawals for your first home are completely tax-free, just like the TFSA. Lastly, we have the non-registered account. If you max out your other retirement accounts, you can still invest here, but gains are taxable. The advantage is no limits on contributions or withdrawals. So the big takeaway: start with the TFSA if you're just beginning. Use an RRSP if you're saving for retirement or have a higher income, and open an FHSA if you're saving for a first home. Once you've picked your account, the next choice is ETFs versus stocks. ETFs, or exchange-traded funds, these are baskets of stocks, giving you instant diversification and lower risk. For example, an S&P 500 ETF, like VFV in Canada, invests in the 500 largest US companies. Next, we have the total stock market ETF, like VTI. This covers the entire US market, from giants to small caps. Also, we have international ETFs like XEF or VXUS, giving you exposure outside of North America. The advantages are ETFs have very low management fees. For example, VFV only charges 0.09% on a $10,000 investment. That's only $9 a year in fees. Compare that to a mutual fund, which might cost you 2% or $200 a year. Huge difference. ETFs also tend to be less volatile than individual stocks. Now, in regards to stocks, stocks have higher risk but also higher rewards. If you hold for at least 10 years, they can really pay off. Beginners should look at stable blue chip companies like banks, railways, or telecoms, and maybe add a few growth tech names like Microsoft or Google. Most beginners start with ETFs as the foundation for their portfolios, and then add a few stocks they really believe in. Now you need a platform to invest on. In Canada, you have choices like Wealthsimple, Questrade, and the big banks also have investment vehicles. First one is Wealthsimple. Super user-friendly, commission-free trading, but limited in advanced features. You have more traditional, like big banks, safe and familiar, but tend to have very high fees. Lastly, we have Questrade, and my personal favorite. No annual account fees, and ETFs are free to buy. I'll leave my referral link in the description if you want to sign up and get started. One of the biggest mistakes beginners make is thinking they need a ton of money to start investing. You don't. Even $100 a month can grow into something massive thanks to compound interest. Let's say you invest $100 every month into VFV, the Canadian S&P 500 ETF, earning an average of 8% per year. After 30 years, you'd have almost $140,000, even though you only put in $36,000 of your own money. The key is consistency. Get into the habit of investing monthly, and over time, the snowball effect will do the heavy lifting. Before you begin your investing journey, here are 5 beginner traps to avoid. Number 1. No meme stocks or penny stocks. Stick to companies you know and that have stood the test of time. Number 2. Time in the market beats timing the market. Don't try to guess the perfect entry point. Number 3, don't wait to start. Even small amounts invested early are better than waiting. Number 4, don't panic sell. When markets dip, it's completely normal. Think of it like a sale at your favorite store. Dips let you buy great companies at a discount. Number 5, stick to your plan. Investing is about discipline, not chasing hype. Follow these rules and you'll avoid 90% of the mistakes new investors make. So that's the beginner's guide to investing in Canada. Pick the right account, choose between ETFs and stocks, open a brokerage, invest consistently, and avoid the common traps. If you found this helpful, make sure to like the video, subscribe for more investing breakdown, leave your questions in the comment, I'd love to help you out. And check out my other videos where I break down stocks like Tesla, Amazon, and Meta in under 60 seconds.